obviously enjoying these episodes because here you are back for more 1% Weekly. This week we're going to hear from Jonathan J for the last time. This is a guy who's sold 26 companies in 21 years, and he's going to give us some insights into how to maximize the exit from our business. We'll also take the final stroll around Robert Kiyosaki's cash flow quadrant with Elite Investor Club member Paul Cronin. And I want to talk to you about something that's not such a happy occasion, and that is Tax Freedom Day. So now it's time for the final leg of our journey with Jonathan J. He's already shown us how to find the right business, how to fund the acquisition, and how to fix it. Now he's going to tell us how to flip it. Okay, so Jonathan, we've found our business, we've funded it, and we've fixed it. Now comes the interesting point, the liquidity event when we sell it. So what's the best way of going about a business sale?
Well, it's the complete opposite of what most people do. What most people do is they operate a business their entire lives and they time the sale of the business in accordance with when they want to stop working, because the two things obviously are connected, although they don't tend to be because of deferred consideration and earnouts. But they think at this early stage that when I sell the business, that's when I retire. So they're putting all their business eggs in one basket. So all that needs to happen is you lose a client, you lose a key member of staff, maybe there's a change in legislation that negatively affects the business, and suddenly those 25 years of hard work dissolve into nothing. Or, more realistically, they probably don't get the value they think they're going to get. Because in their head, they said, I've worked for 25 years, it's got to be worth millions. No, you made a loss last year, it's not worth millions. So that's what most people do. The right way of doing it is following what I describe as the rule of 6. The rule of 6 is where over a period of time you build up a portfolio of 6 businesses. Maybe 6 businesses in the same sector, maybe different sectors, maybe complementary sectors. And then once you've done the fixing process that we've already talked about, you would then say, which one of these businesses maybe is ripe for selling? And perhaps you are approached by someone who's interested in buying one. And that's always the best thing. When someone approaches you, it places you in a far stronger negotiating position. And maybe you're just going to sit and wait for someone to approach you. Maybe when you're networking, you're telling people how wonderful your portfolio is. People say, well, so you have a dental practice? Well, that could be, I know someone who's interested in buying dental practices. Oh, I'm not really interested in selling, but send them my way. You never know what might happen. We'll have a coffee. So you'd sell one, and then you'd buy another one that year as well to replace the one that you sold. So you always have 6 in your portfolio. So you sell one, you hold 5, you buy one. So you sell one, you hold 5, you buy one. And then you've got 6 cash producing assets at any one time. And you've now got a series of liquidity events, as we describe it. So big paydays, winning the business lottery, as we also call it, that you have over a period of time rather than just a one-off event at retirement.
Okay, so I like the idea of building a portfolio, and I like the idea of, obviously you've got cash coming in from them, but you're also, because you're fixing them, you're making them worth more as you go over time. But in the same way as we were quite creative about finding the business in the first place, I guess you also have to be quite creative about how you sell it and to whom you sell it.
Yeah, so it's really the flip side of the buying. You do it's rather hypocritical, but you do the opposite of everything you did when you're buying a company. But the very best position to be in is not needing to sell and not really being bothered whether you sell or not. You will always get the best price. You will always get the best terms. Being able to walk away from a deal is the strongest negotiating position you can have. Now, if you are 63 years old and you want to retire in 24 months' time, you're under pressure. And that isn't a great place to be. So having a portfolio which is all producing cash for you under management, remember, you're not turning up to the office every day, means that you can sit and bide your time and wait, and you're not in any desperate need to sell. Desperation reduces your price.
Okay. And also I think to some extent there's an opportunistic side to this. I recently gave a talk to a room full of vets who've just sold their businesses to some big corporates that are going around hoovering up as many local vets practices as they can, in many cases for as much as 15 times their profit. So I guess if you're watching out what's happening in your industry, sometimes you'll get this kind of once in a lifetime opportunity to sell big.
Yeah, so the veterinary sector has gone through a period of massive consolidation with private equity groups buying up veterinary practices and paying multiples which were unheard of a few years ago. So yes, there may be an opportunity to, if your timing is right, to be acquired. I mean, I sold a business just before the recession, so at the very end of 2007. So Northern Rock had collapsed. Things were happening in the States, but we didn't really realize what the impact was going to be in the UK. And my timing was rather good, but that was luck more than judgment. So these things can sometimes, but again, if you've only got one business, you want to be lucky, right? But you're rolling the dice on one business. Build a portfolio, and then it takes away the anxiety about getting the right timing.
Okay, and we talked a lot about the due diligence that we would do before buying a business. I guess you equally have to do some due diligence on the potential buyers of your business at this selling stage, because you need to make sure they're the right people who will run the business properly, especially if you've got all this deferred consideration. You do sometimes hear of the founder or the entrepreneur selling the business and the people making a right mess of running it and sometimes even buy it back.
Absolutely, happens all the time. So you need to protect. It's not so much because you can't ever predict how someone's going to run your business. You may look at other businesses that they own and maybe they've had some success stories, but that doesn't necessarily mean they're going to be successful with yours. So you need to protect the deferred element of the consideration. And thinking of a business that I sold that had a deferred element as part of the deal structure, I got a debenture over the business that I was selling. I got a debenture over the business that was buying the company that I was selling, and I got personal guarantees from the owners, the shareholders of the business that was doing the buying. So I was belt and braces on every element of that deferred consideration. So I was going to get that deferred if the business that I sold didn't work. I was going to get that deferred if the business that bought the business that I sold didn't work, because it all led back eventually to the directors. So that's quite extreme, but it's complete protection.
And I guess in the same way as you walk away from a potential acquisition, do you find yourself turning down a deal that you may superficially work on the numbers, but you just don't have enough confidence in the person doing the buying?
Well, again, if you've got the protection, it doesn't matter so much. I mean, so I don't want to be too blunt, but it really just comes down to the money. Is the number right for you? And I know that a lot of business owners do talk about, they want to make sure their staff are looked after, and they want to make sure the customers are looked after. And I get all that emotional stuff, but I also think there's a certain, people feel as though that's the right thing to say. They don't want to sound too brutal about it. But believe me, when they're on their world cruise, they're probably not thinking about Mary in accounts. They're spending the money that they have that they deserve and they've earned. So I think that the numbers have to work and the deal structure has to work more than anything else.
Okay. I think finally, I don't want to, over-egg the expectations, but I think it has to be said that, some very significant amounts of money can be made by following this process we've described over these recent weeks. So, can you give some examples without naming names of the kinds of deals you've seen, from this is what I paid for it, this is what I sold it for?
Yeah, I mean, if you buy distressed assets, the ROI is incredible, because you're effectively buying the distressed assets for nothing. So therefore, you can take distressed assets that you buy for nothing, even if you sold them for $250,000, 3 weeks later to someone else because you've cleaned up the legal entity, you've restructured it, and you sold them for $250,000, then that has to be a good ROI for most people. Consider that pretty good. Or you can hold them a little bit longer. So I've bought distressed assets effectively for £1, then I've sold them for millions of pounds within a 12-month period. Now, I'm not suggesting that that's what people do as beginners or what they would do on their first deal, but it's certainly possible. But then I've started businesses from scratch, held them for 6-7 years, and then sold them for millions of pounds in cash as well. So the upside is absolutely huge. I mean, investing in property is a good thing. Investing in lots of things is a good thing. But business is another asset class to invest in. And what you can do is you can take the cash that the business produces and invest it into other things.
Jonathan J., thank you very much for your insights. So I hope you can sense that what you've had there is a kind of a mastermind training condensed into 4 interviews. And believe me, this process of buying and turning around companies really can make you millions of pounds if you get it right. But you do need a lot of help and guidance and support. So do get in touch if you want to take that further, and I'll be happy to introduce you to Jonathan and his group. So now it's time for the final part of our discussion with Elite Investor Club member Paul Cronin about his journey to financial freedom. And he's walked us all the way around Robert Kiyosaki's cash flow quadrant until we end up today in the investor segment. So Paul, we come to the final part of the cash flow quadrant, the I for investor piece. So you've built this portfolio now. It's doing its job, it's generating the passive income. What next for you now as you move into being an investor as well as a business owner?
Well, I have to come up with a plan B because, you know, with George Osborne's invention of Clause 24 of the Finance Act and other things, you know, increase in SDLT, compulsory HMO licensing, much tighter tenant regulations, the possibility that the VOA may ban individual lockable rooms for separate council tax, that potentially, you know, in total, could make our business non-viable. So we've got it up and running. It's generating good cash flow. We've enjoyed good capital growth. It's running almost passively, but I've really got to look at other things just in case. You know, I really don't think the government understand that there are such things as good landlords, and that the private rented sector is actually providing a really valuable supply of good quality housing. You know, where are these people going to go? The councils can't house them. I think it's, you know, potentially a social disaster. But, you know, if we did have to liquidate, or if the profitability does reduce on our properties, I've got to look at 2 things. First of all, I've got to look at better tax planning, you know, possibly incorporation. And the other thing is I've got to start looking at making my money work better for me. Because, you know, I've invested in property education. Now I'm investing in financial education, you know, largely with the help of Elite Investor Club. And there's a few sort of principles, some of which I've always had and some of the things that I've learned recently. And, you know, they include in making sure that the yields are greater than inflation. Otherwise, you're, you know, if you're not getting more than 4%, then your investment is actually going down in value. I've always, you know, I've done CFD split zeros in the past, haven't really worked out. You know, the only person that's made profits is, you know, is the stockbroker.
No, absolutely, and you know, quite often, of course, it's in their interest to try and keep you making transactions because that's how they get their commissions. But obviously, you've talked very kindly about learning stuff with Elite Investor Club. What other things have, you know, played a part in this financial education that you're going through at the moment, Paul?
Well, you know, one of the books I read is, you know, by Andrew Craig. You know, I'd highly recommend that, How to Own the World, and that taught me. You know, that's taught me some principles I was sort of aware of, but it reinforced them. And, you know, one is, you know, don't put all your eggs in one basket. You know, invest above inflation, which I've already mentioned. And the other one is build a, you know, a diversified. You know, you need a foundation of strong assets and income-generating assets, and, you know, building this wealth pyramid. But also making sure that you're diversified in terms of, you know, geography and industries, and make sure you're not exposed in one particular market. So if there's a downturn, you know, in the UK, for example, you know, you don't have a massive hit.
And this is what worries me about traditional residential buy-to-let. You know, there's an awful lot of what I call dumb money still piling into that. And I gave a talk at the Property Investor Show recently, and just looking around, it was obvious that some of these, you know, gurus are still peddling the same get-rich in real estate story they were 10 years ago in a world that's changed so much that people are going to really struggle to make any money.
Yeah. I really feel sorry for, you know, the guy that's bought one or two single buy-to-lets as, you know, pension provision, and, you know, he may not have been worried about the fact he's not making a lot of income, because especially if he's mortgaged, but he's been, you know, waiting, he's been patient waiting for that capital growth. You know, a lot of them don't even realise that how Clause 24 is going to impact them. And you know, suddenly they're going to get the tax return, and they're going to realise that they've been artificially pushed into a higher rate tax band. And you know, we already see it now. People are selling up, and there's going to be people on the street, and I don't know where they're going to go, because there isn't an alternative to the private rented sector. You know, council waiting lists are overflowing.
No, absolutely, and I think the full impact of that you know, dreadful legislation is yet to be felt either by landlords or indeed by tenants. And I think they got away with it because landlords were viewed as a soft target, yeah. A little bit like business owners. You know, one of the things I'm hearing a lot at the moment is how much the massive hike in business rates is impacting a lot of certainly high street retail businesses. And it seems like, you know, landlords, particularly now they've turned their attention to HMOs as well, are still not out the woods yet. There's still more stuff coming through the channels. So one of the things that I've been doing is moving much more into commercial property, where these new rules and regulations don't apply. So do you potentially see, you were talking about looking for another project, do you see commercial property playing any role in your future as an investor? Yeah,
I've already done a commercial to partially commercial residential conversion, which was quite successful. That is something that I haven't really looked into it, but it's something that I would, you know, be interested in investigating further, because, you know, as you say, you know, we're more resilient to the tax changes because HMOs cash flow very well, but it is going to eat into our profits. And the smart money in single buy-to-lets, a lot of them are saying, this isn't going to make me any more money. So people are moving, and there's more focus on HMOs now. So the competition's increasing, which is another thing that we have to deal with. We have to get smarter, we have to get better and ahead of the game. Okay, so we've talked about obviously how you need to broaden out your education and your investment portfolio. The other point you touched on was tax planning. So just tell me some of the areas where you think you need to get slightly more sophisticated in your tax planning, Paul. Yeah, you've hit the nail on the head there, Graham. We have to have a plan to deal with the impact of the removal of mortgage interest tax relief. But also, you know, we've been quite successful. We've built a portfolio, and we've got to take steps to have a tax planning in place. But also something that we've been very conscious, my wife and I have been very conscious for a long time, is succession planning. You know, we've now got grandchildren. We want to set up trusts for them. So, you know, I'm looking at a way that we can combine efficient tax planning with efficient succession planning to manage the amount of inheritance tax that we pay, because we know we've got a portfolio of shares, we've got other assets, property and you know, buy-to-let properties. We need to come up with a plan, and that's something that is definitely one of my #1 resolutions for this year.
Yeah, and I think again, you said earlier on about you don't know what you don't know. This is an area where I think that applies even more so, that a lot of people are just going to accidentally give 40% of their estate to the Treasury if they're not careful. But there are steps you can take to you know, massively reduce that, but you need to be aware of them. And I know that's a process that you've started.
Sure, yeah. Yeah, I didn't think there was a silver bullet for inheritance tax. You know, you can take it whole life, second death life insurance. That would be quite expensive, I believe. So looking for that silver bullet, I think we found something that's very, very close to that, and that's going to work very well for my wife, for myself, and for my family in the future.
Brilliant. So we've followed your whole journey through being an employee, through being self-employed. Then you've moved across into the business owner, and finally into the investor quadrant. So just to wrap up this little series of talks, Paul, what would be your kind of overall advice to somebody watching this as to how they perhaps need to change their thinking to achieve the things that you've achieved?
I think, well, first of all, they need to get good advice and good mentors. You know, if you've got an accountant you've been using for a long time but is not proactive, maybe it's time for a change. But I think financial education That's one of the reasons that I've joined Elite Investor Club, because I'm not particularly good at doing due diligence, and I like to stand on the shoulders of giants. And when you're in a network where lots of other people are doing due diligence alongside you, that sort of network due diligence is a really powerful tool.
Brilliant. Well, thanks very much for joining us, Paul, and all the best of success in the future with your investments.
Thanks, Graham.
I always love bringing you stories from Elite Investor Club members, because these are real people who've been there and done it. And I hope you take inspiration from Paul to help you on your own journey to financial freedom. This episode of 1% Weekly is being broadcast in mid-July. The scary thing is it's not that long ago, in fact right at the end of May, almost into June, when we had Tax Freedom Day. That's the latest it's been since the 1980s, which basically means congratulations, you and I are working 5 months of the year for the taxman. We get to keep 7 months worth of income. He takes almost half, 5 months worth. And if all the current trends continue, Tax Freedom Day is going to move comfortably into June over the next few years. And we've talked often on this program about the tax burden, but it is actually unfairly skewed towards the better off, because the top 1% of taxpayers pay 28% of the total tax take in this country. So 1% are paying close to 1/3 of all taxation. But the bigger question we have to ask is are we just going to let this go on and on and on increasing? Are we just going to let the tax burden get higher so that we spend longer and longer getting to Tax Freedom Day? Have we all gone off on our summer holidays before we reach Tax Freedom Day? The problem is there seems to be a no appetite for further kind of cutbacks. We have all these kind of protests about austerity, when the reality is that the government is spending more and more and more all the time, the national debt keeps rising, and the tax burden has to keep rising. So where does this go? I personally don't like the idea of working 6 months of the year for the government. We all know we need, yes, hospitals, schools, roads, etc., but there's got to be a better way than simply increasing tax year after year after year. And I think nothing brings this home more sharply than Tax Freedom Day. So I'm grateful it exists as a measure, but I'm not very happy that we're now paying the government from January, February, March, April, all of May, and soon we'll be trickling into June before we get to keep any of the money. As we come to the end of another episode, there's a lovely story I want to share with you that came out when I was filming my new TV series, Finding Financial Freedom, a few weeks ago. One of my guests was Elite member Elizabeth Benjamin, and she told her story about how she'd built a whole property portfolio from very little capital in the early days when she was holding down 4 jobs. She now has quite a substantial property portfolio, and a few months ago there was one of those big electric storms, and it took out the boilers in 2 of her buy-to-let properties, and these things were like £2,500 each. Now, in the same week as this happened, she received her annual rental income on one of the dementia care home suites that she'd bought through Elite Investor Club. So she had $5,800 of genuinely passive income arrive in her bank account. So she had to use that money to cover the 2 new boilers in her buy-to-let portfolio. She called it miracle money. It was obviously getting her out of a real hole. But it really reinforces the story of what you mean by passive income. Most buy-to-let landlords think they have passive income. Well, it ain't passive if you have to replace the boilers every time they blow up. Passive income is what happens with those dementia care home suites when the money just arrives in your account and you don't need to lift a finger. Thanks for watching 1% Weekly. If you've enjoyed what you've seen, you might want to click here to subscribe for future episodes, or you might want to click here to watch this other video. What are you waiting for? My arms are getting tired.